has gone through significant challenges, but I think today is another little wake-up call, not to bring up terrorism, but recently there was a wake-up call, a small one, in London here, reminding us all that we're not immune from terrorism. Of course, we experienced that in 2001, 9/11, which was a major wake-up call. But there's a financial wake-up call going on in the world, and it could be as big as 9/11 was. Financially speaking, 2008 and 9 was. This could be the small London wake-up call financially right now with Deutsche Bank. What's happened is bank is having all kinds of problems. Once again, their financial calamity is facing them straight in the face, and the CEO, John Cryan, who took up the job as CEO in 2015, said then that the bank would not go to the markets to raise capital for more money. I think that's, if he knew what was going to happen, he wouldn't have said that back then, because that's clearly what he's doing here recently. On Monday, Deutsche Bank announced that they're going to create more shares. They need to raise $8.6 billion by selling their shares at a discount, a 35% discount. So imagine for a second, this announcement comes out, you're a shareholder in Deutsche Bank, and now you realize you can buy the stock 35% cheaper from Deutsche Bank itself coming up when they release this. Obviously, the market has to go down. Well, the market has gone down 13% in 4 days already as a result of this. You're probably wondering, well, why do they need $8.6 billion? Well, they've gone through their tremendous problems, Deutsche Bank. Due to the nature of their business, Deutsche Bank has been involved in various litigations and arbitrations and regulatory proceedings both in Germany and also in a number of jurisdictions outside of that country, specifically with our country in the Department of Justice. They caught them in fraud, and they've done several things in reference to being in trouble. There was a probe in 2014, an investigation that they were with Barclays Bank and PLC and BS conducting also the same thing. Goldman Sachs, JP Morgan, Chase, UBS, Credit Suisse, Bank of Nova Scotia, and a France-based Société Générale and Standard Banking Group. They were found guilty for manipulating financial markets, specifically metals. And Deutsche Bank was the spearhead of this, so they paid the fine, $60 million. Their fines keep going on. $7.2 billion is now owed to the Department of Justice. That's a lot of money. They don't have the money. They also have a $10 billion litigation bill trying to fight the Department of Justice, because it was $15.1 billion or $14.1 billion. They got it knocked almost in half. So Deutsche Bank's troubles just keep going on, financially speaking. So they got to raise $8.6 billion to cover enough money to pay for a portion of that and all the other fines, and to keep the grease in the wheel for their company to keep moving. Their stocks have taken a hammering the last couple of years, the lowest level in the history of 20 years being in business. And what they've lost almost $2 billion in the last 2 years combined. And last year, or just recently, they slashed bonuses 80%, suspended had a hiring freeze, but it just keeps going on. They also have a $2.5 million civil penalty that they need to pay to the Commodities Futures Trading Commission for failing to report swap transaction. Because of all this, Deutsche Bank has just got downgraded by Zacks, ranking them as a strong sell. Zacks is based out of Chicago, one of the most reputable of them that reports independently. They have a team of experts that have a very good, strong track record on what to buy and what to sell. And they're putting the sell, not just a sell, a strong sell out there. So you're probably wondering, why am I even telling you this? They're across the pond. That makes no sense. What effect does that have on me? Let's put it into perspective. If you haven't heard my previous podcast on Deutsche Bank, I'm going to give a quick rundown in a couple minutes of this. We all remember Lehman Brothers. I talk for a living. Lehman Brothers. Lehman Brothers is nothing compared to the size of Deutsche Bank. Deutsche Bank is the bank that funds the Euro system for and its projects. Historically, they have. They're not able to do that now. Deutsche Bank is 10 times bigger than Lehman Brothers. Deutsche Bank makes the majority of its money from derivative trading. Derivative trading is what brought down Lehman Brothers. Deutsche Bank announced from 2014 to 2004 to 2015, that 11-year span of time, 90% of Deutsche Bank's revenue came in from derivative trading. The whole house of cards came down through all these scandals that they're involved in. They also were involved in, if you remember, the LIBOR manipulation. Deutsche Bank was at the head of that too. So you look at where there has been manipulation, that road does more than likely go back to market manipulation. That road definitely will probably go back to Deutsche Bank, if not be the first company or bank that started it or spearheads it. So because this all started out in a probe in 2014 and 15, really full bore, Deutsche Bank stopped doing the most of its revenue from derivative trading because it couldn't make, that's where it made the majority of money, and an incredible amount of money can be made through derivative trading by banks. They stopped doing that. Now they don't have enough revenue. They've had 2 years of losses except for 1 quarter. So now they're moving forward in doing it the old-fashioned way, lending out money. So let's look forward. Deutsche Bank doesn't have enough money. They're going to raise money through the market, which John Cryan said they're not going to do in 2015. They need money. They got to manage that money in shares also and pay dividends. By the way, they cut back on their dividends in their stock too. But if Deutsche Bank goes under, it will be a walk through the park like 2008 like a walk through the park, according to Fox News. Fox News said if Deutsche Bank goes under, within the first day, 3 major U.S. banks will go solvent, and within 5 trading days, 7 major banks in the United States will become completely insolvent. That's how big Deutsche Bank is. So this is why we watch Deutsche Bank, because if we knew that 2008 was going to happen, or something that came close to triggering 2008, this is why we put out the warning sign of this. We are on the verge of this happening. Now, here's why. Think with me for a second. If their stock is at $19.60 before this announcement, now it's at $17. People are going to probably start shorting the stock. And if the Zacks gives it a rank and categorize it as a strong sell, you're going to see financial institutions start to short this bank stock, I believe. This is exactly what will catapult and snowball the stock going to lower prices. They haven't even released yet the buy opportunity to buy the stock internally at 35% less. That in and of itself is one that starts this cataclysmic event. On top of that, when traders see this happening, they're going to short this stock. That's what they did with Lehman Brothers. Part of Lehman Brothers falling is financial institutions said, we're not going to help them get bailed out. We're going to short them and make a lot of money. And that's exactly what happened. A few months ago, the Chancellor of Germany, Angela Merkel, said that they're not going to bail out Deutsche Bank. It's against the European guidelines to do that anyway. Well, she affirmed that. I think John Cryan was expecting that he would get some sort of a bailout. Now that they're not, the stock is going the other direction. If it breaks down below 10, a technical and a psychological fundamental barrier, when Lehman Brothers did that, it was a quick falling down the stairs to the collapse. We're $7 away from that. May seem like a lot, but in a $17 stock, that's not that far off. When you crunch the numbers at 35% at a $17 stock, let's do that, $17 times 35%, that means that's a $6 lower. So now we're at $11. That's current market. They haven't announced when they're going to release this program yet. This could possibly be released and drive the stock internally under 10. So it's very imperative that you listen to what's happening here, I'm not a doomsdayer and I'm not a Chicken Little, but we are definitely having the recipe, the makings of an early 2008 and 9 that Deutsche Bank could trigger this thing. Why am I saying all that? Because this time around, we have almost a $20 trillion debt versus a $10 trillion debt before. We have foreign governments selling the dollar, called treasuries, at the fastest rate in the history of our country, according to the U.S. Treasury report last put out in December. 80.1 billion treasuries were sold in 1 month by foreign entities in getting out of the treasury market. There was a buying going on in treasuries on foreign banks in 2008. There's a selling going on now in foreign banks in 2017. So this time, we have a law called the Dodd-Frank Act that has changed the legal ownership of our money, that this time there won't be the Fed probably being able to come to the market and creating a thing called quantitative easing and printing all this money to inject in the system. This time, we will probably see follow in the footsteps what foreign countries did, and they did a thing called the bail-in. It happened in 9 countries where their government went into their citizens' accounts, seized them, pensions, retirements, bank accounts, and gave them either a stock in a failing bank like Cyprus or a bond, and then later walked away from the bond like they did in Poland, and they defaulted. Steve Forbes even wrote an article about that specifically in Poland. And he recently talked about a bail-in. The likelihood of it happening in America is now rather high. So we're on the crest of this. I got a new report that talks in detail of this and puts all the pieces of the puzzle together. It's in its 6th edition. You can get it by calling my company at 877-448-2646 or go to landmarkgold.com. It's called The Coming Bail-In, the new 6th edition. I also have a new newsletter that just came out, the March newsletter. Get ready for the next bubble, higher interest rates. The Fed's now raising rates, and we could see this in a bubble. So call into my company, you'll get that and some other things that will help you, how you can roll over your 401k, your IRA into physical gold and silver and take possession of it. Learn how to do that without any tax ramification. I know a lot of people say, did he say that right? Yes, you heard me right. And you'll see the legal pathway to do that, and we'll help you understand that. We have a white paper on that also, specifically that. So, again, call my company and get the facts, get educated. There's no pressure. We believe in education. 877-448-2646 or landmarkgold.com. Until then, this is David Fischer, CEO of Landmark Capital. This is The Golden Rule.
This has been another installment of The Golden Rule with David Fischer. To stay up to date and find out the latest information, go to landmarkgold.com.